Today, I do like to talk about investment preparedness. I call it investment preparedness, being prepared to invest. But first of all, I'd like to say I'm not an investment expert. I'm not an investment professional. Speak with your financial advisor, your accountant. Speak with these people that are investment experts to guide you so that you can make informed decisions. This information is for education only. It's for you to at least have that information. I hope I'm able to expose you to what's possible information that you can use in changing your financial behaviors, in seeking more information so that you can make informed decisions. So this information is just for education only. Now, having got that out of the way, I do like to say many people delay investing, thinking, oh, investment is a luxury. I'm going to invest when I have attained some kind of financial status. I'm going to invest when I start earning so amount of money, when I have so amount of, maybe when I get my financial independence number. They kind of think, oh, it's so, investment is complicated and all that. But that's one of the reasons why I am sharing this on today's episode, that investment doesn't have to be complicated. You can start. So first of all, let me just draw the distinction, the way I see investment. In the last episode, I talked about savings. I like to view it as the amount that you put away for certain goals, principally to make that money cash available to you when you need it. And most times it's more of short term. It could be long term too, but most of the time you're saving towards an emergency fund. You're saving maybe to build equity to buy a home. You're saving for education. You're saving for a project. But in savings, you're not really concerned. You shouldn't be concerned about the returns. You're just primarily concerned about putting that cash away so that you can access it for the goal for which you have put it away. But for investments, when we're talking about investment, you're looking at returns. There are some risk associated with investments. At the same time, there are rewards to it as well. That's why there are risks. Look at, for example, if you are a working professional, if you are different from the person that owns a business. If you are working in an organization, look at the risk that you put into that business compared to the risk of the person that actually started the business. The risk is not the same. And so the reward of the person that started the business is going to be greater than the employees of that business. So that's the same way you want to look at investments. The more the risk, usually the more the reward. Are your finances like a messy pile of papers scattered across a table? You don't know where to start and it feels so overwhelming. Imagine if someone could organize those papers into labeled folders, making it easier for you to take action at the moment that it's needed. Look, you might feel disorganized about money, even ashamed to talk about it. If you would rather feel in control about money, connect with us at wealthEd.ca. That's WEALTH-ED.ca. Having said that, I would like to also say that when you're looking at investments, do your research, and it's always align what you want to do with your risk appetite. There's something called risk appetite. Some people have some money they can play with. Some they can't afford to play with such money. So that's, how much can you afford to, because when we're talking about investment, you may invest, for example, $500, and maybe you buy shares in a company worth $500. What if they don't do very well as you have projected? If you if you had bought shares of $500 in a particular company, and that company at the end of the day did not do as well as you had envisaged they were going to do, that means your $500 is not really $500 at the end of the day anymore, because the $500 would have reduced to the value of how the business that you bought those shares in have performed. So that's why you want to, you want to invest in line with your risk appetite. There's also something called diversification. You want to make sure you diverse. You want to make sure invest in, you don't put all your money that you have allocated for investment in one place. Just because of what I just said. What if that place you put your money in, what if that particular business or particular portfolio, what if it doesn't do well? Well, having said all this, I like to encourage people to look at research about index fund. That's why I like index fund. Index fund, I like to explain it as, I just talked about having, buying shares in a business. Now, index fund is, there are professionals, they have already researched, they've already done all the homework, they've already done all the necessary analysis, and they now put a basket of the shares of a company in a fund. Take, for example, maybe the best 500 companies in the US or the best 500 companies in Canada. So these professionals, they've put this best 500 companies in a fund. And so as an investor, you can access that fund. You don't have to go to each of the 500 companies and start buying shares in each of the 500 companies. With as little as $50, $100, you can buy into that fund. That means let me use an example. So just for the sake of illustrations, take for example, you use $100. You say, there's an index fund of the first or the best 500 companies in Canada. Then you say, I'm going to be investing $100 of my money every month into this index fund. What that simply means is every month when you take your $100 to invest in that fund, you're using $100 to buy a piece of each of the 500 companies that is inside that fund. And why I like that so much is not all companies are going to do well at the same time. So your $100 is really, really diversified. So if one company doesn't do well, chances are that some other companies in that basket, in that fund, are going to do well. And so your risk is kind of like reduced. That's why I like it. And there are, nowadays it's so simple. Again, I just like Wealth Simple just because I use them. There are many other ones out there that you can use. Do your research, talk to your professional. For the sake of this illustration, if you use Wealth Simple, you can buy into an index fund, you can automate it. You can say, at every of my paycheck, for example, $50 is going to go into this index fund, and I'm just going to leave it there. You've automated it. Wealth Simple, they buy it for you, or wherever you want to use, they do whatever, they do the buying for you. And you know that with $50, as in the case of our example, you are using that to buy a piece of maybe the best 500 companies in Canada, just as an example, just so you get what I'm saying there. Now, having said all that, I also would like to say, I like to encourage the people that I work with that see investments in terms of long term. Don't see it as, I'm just going to, I want a quick returns. I'm going to look at investing here, and immediately this, business or this venture does very well, then I'm going to pull out my money. And, people that have done that in the past that I've worked with, they tend not to be happy at the end of the day, because it didn't really go well, and it gets all complicated and all that. I'm not saying people that do it, if you have the time, if you have the knowledge, fine. But I'm talking to, working professionals, assuming that this is new to you, you just want to start, you just want to venture into into investing, you don't have the time to be really, picking stocks and all that, then of course I usually encourage people that I work with. That's the reason why you should go with index fund, and that's the reason why you should view it long term. So have a long term goal. I'm going to leave this money there for the next 10 years, for example. That's the power of compounding. Compounding is simply, whatever the return, say the index fund that I've said, maybe there's the fund that you're investing your money in, maybe it's performing at the rate of maybe 7% return on your money. If you leave that there for example, 10 years, now what compounding means is that whatever at the end of year one, for example, if you had, just for the sake of example, if you had maybe $1,000 in there at 7% returns of $1,000, that's $70. So $1,070 by year two, the 7% is going to be on your 1,000 plus the 70, and that's how it's going to be, every period. So the return is not going to be on the principal only. It's going to be on the interest that has accrued to you. That's the returns that you've gotten on that investment, and it's going to be on the monthly, investment that you keep on putting into that investment. At the end of the day, you see how that works for you. That it's always very powerful, and the value is really in the time, giving it the time to actually work for you, giving it time to return the value that you emphasize, the value that you are looking forward to it. Again, I would like to encourage you, having said all this, do your own research, speak to an investment expert. I'm going to be dropping some resources in the show notes to help you, if you're looking to where you can look at to look for example, more information about index fund, more information about how you can automate your investment. I will drop those resources in the show notes. Hopefully that's helpful for you in one way or another. And I'll see you on the next episode.